Alright, for this video I want to go over a sample form 1040X, which is an amended U.S. income tax return. Now in this scenario we're going to look at a 2023 amendment for a taxpayer here, J&Q taxpayer, and she needs to file an amended return because she incorrectly reported a Schedule K-1 partnership investment as a non-passive activity when it should have been passive. So we'll look at the 1040X here, which is 2 pages. We've also got the amended 1040, so we'll have a look at the changes that are made and then how those values get carried over to the 1040X. We've got the original return here, which we'll need to have a look at to see what went wrong and how to report the original numbers. And then we'll also have the Schedule K-1 from the investment, so we'll take a look at this as well. We've also got one slide here covering some background on the amended returns and more details on the fact pattern. Now, when we talk about making changes to a 1040, it's either an amended return or a superseded return. Now, amended returns don't replace the original, but they do correct for things that were errors that were made, right? So if you made a mistake or you omitted something, you can file an amended return to fix that. Now, amended returns can also be filed for carryback claims like Section 1256 losses, foreign tax credits, net operating losses, but most of the time you're filing these to fix something that went wrong. Now, you can file these generally whenever, but the problem you have with refund claims is there are some statute of limitations. So if you have a refund claim, so you're trying to file to get some money back because you overpaid, you've got to file within the later of generally these 2 dates. So it's 3 years from the date you filed or 2 years from the date you paid the tax. Now, superseded returns are a different story. So superseded returns completely replace the original return. So it's as if you never even submitted that original and now you're filing a brand new Form 1040. Now, superseded returns, although they're preferable, there's greater time constraints. So you can only file a superseded return after the original return is filed, but you need to be able to submit it before the original filing deadline, or if you extended, you get the extended deadline. So if you've missed something and it's been a couple of years, amended return is going to be your only option. Superseded return dates have passed. Now, if we have a look at the fact pattern here, we've got Jane, who's a single filing taxpayer, and Jane timely filed her 2023 Form 1040 on April 12th, 2024. She did not file an extension request. All right. Now, the reason why that's important is because if the due date has passed, which it will in this fact pattern, she can no longer do a superseded return. She has to do an amended. Now, the issue she had here is in 2023, Jane invested $10K into a local restaurant business operated by her friend. The business is structured as a partnership, so Jane was admitted as a limited member and received a Schedule K-1 at the end of the year. Jane does not materially participate in the business, and she is merely a passive investor. Jane's Schedule K-1 showed an allocation of line 1 ordinary losses of $9.50, and she had interest income of $5. Now, on Jane's original return, she mistakenly reported the ordinary losses as non-passive, and she deducted those losses against her other ordinary income. This is the problem, right? She has a passive activity loss here and should have treated it as such. So if we have a look at the K1, go through these elements really quickly. So it's a 2023 K1. We can see here that she's a domestic partner, limited partner, or other LLC member. And then we have her capital account reconciliation here. So she put in $10,000, had an allocation of net loss of $945. And that amount comprises these 2 pieces. So we have line 1, ordinary losses of $950, and interest income allocated of $5. Now, on the original return here, if we have a look at what she did, we see firstly on Schedule B, she reported the allocation of the interest, so that's fine. And then on Schedule E, she reported the partnership investment, so partnership name, LLC, P for partnership, EIN. And then the loss is reported in the non-passive income and loss section, column I, for non-passive loss allowed. Right? This is wrong, right? So she had to have it over here as passive income or loss subject to those passive income loss limitations. So the 950 was taken, and ultimately that flew through to Schedule 1, Part 1. And so we can see on the 1040, page 1, we have a deduction here for $950 related to that business activity. This is what we have to reverse, right? This was not appropriate to take in the current year because it is a passive activity loss to Jane. So on the amended return now, here are the changes that we're making. So if we look at the 1040, if we look at Schedule B, so that remains unchanged. So we have the $5 there, that's fine. But on Schedule E, notice now that we've removed the non-passive income or loss piece, and now we have to report these elements on the 8582. So Form 8582 is where we report passive activity losses. So on page 2, she's reported now in Part 5, right, the partnership investment, current year net loss of $950. There's no prior year unallowed because this is her only investment, and this investment was started in the current period. So the overall gain or loss here is $950, and this is going to be a passive activity loss. So the allowed losses here for this investment in the current period are going to be 0. The unallowed is $950. And so on Schedule E, the passive loss allowed for the current period is going to be $0. So now that we've updated that $0 figure, the Schedule 1 has been updated to zero that out. We're not claiming the loss anymore. And then on the 1040, you can see here on Schedule 1, no more deduction of the loss. So now, once we figured out how the 1040 should have looked like, now we can figure out how to prepare the 1040X. So the 1040X here, we've got the tax year that we're changing up here, 2023. First name, last name, social security number. Her filing status is single, so that remains unchanged. And now we populate columns A, B, and C. So column A are the original amounts as reported on the 1040. So you would have a look at the original return. We're looking for items like the adjusted gross income, standard or itemized deduction, taxable income, taxes owed, and so forth. So we've pulled through the AGI, the standard deduction, the taxable income from the original return, the amount of tax that we owed on this income, $13,014, the amount of tax being calculated, the QDCGTW, that stands for Qualified Dividend Capital Gains Tax Worksheet. And the reason we had to use that worksheet is because we have some qualified dividends and capital gains. So you have to use that worksheet instead of just the ordinary federal tax tables. So once we have all these elements in place, and then the last one is line 18, the original overpayment as shown on the return. So on the original tax return, if we look at our refund, it was $3,486. So we've inputted $3,486 on line 18, and now it's a matter of figuring out what is the correct amount in column C, and then we report the net changes in column B. So column C has changed because we removed the $950 deduction. Our AGI increased to $95,330. So if we're looking at the amended return now, we would pull these values into the corrected columns that we changed in column C. So we have the AGI, the standard deduction, our taxable income now is $81,480, and we recalculate our tax on this new taxable income, again using the qualified dividends and capital gains tax worksheet to arrive at $13,223. Now I won't go through the capital gains tax worksheet in detail. I've got some other videos on this, so I'll put those links below. But again, the idea here is if you have any qualified dividends or capital gains, you should be using this worksheet to figure out how much tax you owe, because you get preferential rates on those types of income items. So $13,223 is the new amount of tax that the taxpayer owes. So the difference here is an additional amount owed of $209. So we owe money because we understated our income when we first filed the return. So $950 income change, $209 of additional tax is going to be owed. And so when we complete the rest of the worksheet here, we have line 19. We want to subtract line 18 from line 17. So line 18 minus subtract that from line 17, we're left with $13,014. And then if line 11, column C, up here, is more than line 19, which it is, we subtract the difference and we're left with $209. So $209 is the amount of tax that we owe for this mistake that was made on the prior year return. So Jane can go ahead and complete the rest of the 1040X. We just have to do page 2, part 2, an explanation of the changes. And so here we lay out exactly what happened and the changes that we made. So we're filing an amended tax return to recharacterize activity that was reported from a partnership investment from non-passive to passive activity. Taxpayer is an LP in a partnership in partnership name LLC, a non-publicly traded partnership investment. The reason why we want to highlight it's not a PTP is because PTPs get their own separate basket, right? They're treated differently for these rules than if you just have any other non-publicly traded entity. So we've got a non-PTP investment, and on the original Form 1040, the taxpayer inadvertently characterized the activity as non-passive and deducted $950 of ordinary loss against other non-passive income. The amended return reclassifies the activity as passive and reports the suspended passive activity loss on the 8582. All right, and so Jane can go ahead and sign, date this, send it off to the IRS with the payment that she's going to owe, because again, she did understate her income, and the IRS very often is going to charge interest. They won't penalize you, not for a small amount like this, and as long as it wasn't a willful understatement. But yeah, she will owe some interest, she'll owe that tax. But this is important to get it right because we want it, obviously, the taxable income calc to be right, but we also want to make sure that we are correctly reporting our 8582 for these lost carryovers, because we can use them in future years when we do have some taxable income. All right, so that covers it for this video. Hope that was helpful. As always, appreciate you watching and look forward to seeing you on the next one. Thank you.